right. Well, if you thought this week was tough for technology, buckle up because the charts are showing even more pain ahead for this sector. Chartmaster Carter Worth joins us now to break it all down. Carter, what are you looking at?
You bet. Thanks. So, before we get to the charts, it's important to say that equities are not annuities, right? Give-backs, dips, sell-offs, corrections, declines, they're a part of investing. And so it's always hard, though, to figure out how far the decline will go. Let's try to figure that out. A couple charts, 1 of 5. The first one you see here, I thought we'd start with this. It's going back to the early 1990s. It's a 2-panel chart. On the top, you see the NASDAQ composite. Obviously, it's well above its dot-com peak in 2000. But what's really interesting, ironic, and telling, the bottom panel. The NASDAQ, even with all of this, has not recouped its relative losses to the S&P since the dot-com peak. So that bottom panel, with that circle I've drawn, you still haven't made relative highs, which just shows how treacherous it is to buy into the top of a bubble. In any event, the here and now. Let's go to the next chart. So now we're looking at a chart of the NASDAQ, no judgments or annotations, and yet what you can see is a clear break-in trend. I've simply drawn the trend line, it draws itself, and what we know is we have broken trend. This is the first break of the well-defined trend line that's been in effect since the March low. So where to? Well, take a look at the next chart. What we know, and this is now the percentage decline, we're down 11.5% for the NASDAQ index overall. But once you broke in trend, what is your reference point? Could it go to down 13? Could it go 15? Of course it could. So the next reference point, look at the next chart, is the January-February peak from which the market broke out. We know the S&P, of course, has already gone all the way back to its January-February peak. And so were the market to simply go back to the peak of the pre-pandemic high, final chart, what it would be is not an 11.5% decline, which is what we've seen so far, but then we're looking at something in the order of about 18. And so is that a possibility? You bet. It is a pretty good testament to first loss, best loss. If something does crack hard, it's usually right to try to take some measures. And even as Jeff said, we are not oversold.
We're not. Okay, so this is specifically, Carter, for the NASDAQ. For the S&P 500, which you already said breached that pre-pandemic level, is it smoother sailing, or because of the tech leadership, we're also going to see a decline that mirrors this, but may not be as deep?
Well, that's right. So then it's a question about the market's construction. We know top 5 stocks are 25%. We know that, interestingly, just before this crack, the top 15 stocks as a weight just finally exceeded the dot-com peak in 99. And so the question is, the NASDAQ composite down 11.5%, the S&P down only 7.5%. Is there more to go? Well, if the parts compose the whole comprises the parts. If the big parts have more to go, the presumption is that the S&P has more to go.
Carter, good to see you. We'll see you later on Options Action. Carter Braxton Worth at Cornerstone Macro. Jeff Mills, you agree with Carter in this call for a decline of 18.5% on the NASDAQ from the recent peak?
Yeah, I do. And I think the levels he points out are really clear in that you have the pre-pandemic peak, but then you also have the upward sloping 200-day moving average if you look at the triple Qs, for example. So I think that would be a really natural resting point for this particular correction. And I do worry about the overall market, just given the weight of some of these names. And because I think the rotation into cyclicality isn't necessarily primed to take off, that may not carry the day in terms of the broad market. I think in order for that rotation to happen, you need to see things like consumer confidence, the labor market continue to heal. You know, we had this divergence between the labor market and how consumers were actually behaving because of this income replacement. That is now gone. So I think the uncertainty there needs to heal a lot more before you can see that rotation and have that value and cyclicality carry the market higher.
Steve, in Carter's world in which this decline happens, do your cyclical stocks do better than tech?
So I would have agreed with Mr. Mills a couple of weeks ago that all of them get pulled down at the same rate and velocity, the general. But the issue that I'm looking at now is that I am seeing, if you chart chemicals right now, chemicals don't look so bad on their ETF, while tech does. So to answer your question, chemicals and cyclicals will rally even with the S&P falling out of bed.
All right.